So, let's talk about the Q3 earnings from Tesla. And yes, I know there's 150 different YouTubers who already reacted to it, but I wanted to take my time and purpose. I want to slow down, digest it all, and provide you with a deeper analysis instead of the usual quick and shallow breaking news style coverage we usually get on YouTube. Now, I mean no disrespect to any of the other creators, but it's simply not something I want to offer on my channel. I want to provide more of an in-depth value with my commentary. Now, look, first of all, I gotta say, I was genuinely impressed by Tesla's Q3 results. Now, don't get me wrong, this was far from a perfect quarter for Musk and crew, but we knew coming into the quarter they missed deliveries by 4%. Now we know what was the impact, which was the 2% miss on revenues. Now, Tesla did beat earnings per share by 4%, and the strong dollar must have had a negative impact on revenues, but that didn't matter. When you are the world's largest automobile manufacturer, at least by market share, and you are being priced for perfection, and you miss revenues, that's going to hurt, which is exactly what happened when Tesla shares dropped in after hours yesterday and today during trading. Now, the real question, which nobody seems to worry about on mainstream media, is how good or bad are the actual results, beyond the slight revenue miss, beyond the slight earnings per share beat. So let's take a deeper look and find out. Now, first, let's start with the numbers. Golly, automotive revenues went up by 55% year over year, 28% quarter over quarter, all the way to $18.6 billion. Regulatory credits remain low at $286 million, with a 17% decline quarter over quarter and a slight 3% increase year over year, pretty much flat. Now, what's actually quite impressive is that Tesla achieved a 54% revenue increase with just 2% of extra operating expenses to $1.7 billion. That's it. Now, that is why the income from operation is up 84%. Year over year, of course, from $2 billion to $3.7 billion. Now, this company is getting more efficient by the quarter, and you can see it across the board, even in metrics like the EBITDA margin, which went up by 55% year over year, of course, from $3.2 billion all the way to $5 billion. Now, that's even without mentioning the net cash from operation going up by $5 billion during the quarter. Not to mention Tesla sitting on $21 billion on cash, all that with virtually no real debt. I can't think of a company that's more prepared for hard times and a recession and increased rates than Tesla right now. Now, as far as the cars themselves, let's talk about it. The Model S and X production is still very, very slim, but it did grow 123% year over year with 20,000 units out in Q3. Now, Model 3 and Model Y, on the other hand, those are wrapping up quite nicely, all the way to 345,000 units, which represent about 51% year-over-year growth. Now, what's interesting and often gets overlooked, at least on the mainstream media side, is what's going on with the supercharger network. Now, during Q3, Tesla went up to 4,300 stations, 39,000 chargers. That's a 32% year-over-year increase in one of its major selling points over the competition, whatever that is. The numbers are absolutely terrific. We knew that, right? But all of that is already priced into the current share price. The market knows exactly what the present is. We all know Tesla is a great company, but what about the future? Based on these earnings, is Tesla actually still massively undervalued despite its huge PE? Well, that would depend on how you answer these following two questions. And this is where the beef is going to be between the bears and the bulls. So let's talk about it. Let's talk about future projections. Now, this seems to be the battleground between the bullish and the bearish analysts of Tesla, and I find it quite peculiar. So, Tesla said in the earnings call that they expect a 50% annual growth year over year in the next few years, which may sound ambitious at first, especially given the fact that we're about to hit a massive recession, interest rate hikes, The current state of affairs of the economy isn't that great. So, isn't the current share price outrageously high? Well, let's actually examine this without emotions. Let's look at the numbers. So, the question is, can Tesla sell and produce enough cars to justify a 50% annual growth guidance? Is that growth actually reasonable given the current market share? Given the recession around the corner? Can Tesla keep this level of demand going even when loans are getting more expensive? Even when discretionary spending is actually going down? And can it even actually produce all these cars assuming they can sell them? Now, obviously, even for a company like Tesla, a 50% annual growth over the next few years is a very ambitious goal. And some of it is already baked into the share price, but not all of it. Let me explain. With this valuation, any bump in the road is going to have a heavy impact on the share price. As we saw what happened 2 days ago, when the share price actually plummeted because of a few percentage points of miss on revenues, even though everything else was basically firing on all cylinders. So you should be aware of that if you're an existing or a potential Tesla investor. This stock is priced for perfection, and anything short of that is going to be very painful for you as a shareholder. You got to acknowledge that before you jump in. Now, as far as numbers go, let's start with production capacity. In other words, can Tesla increase production that fast? Well, in Q3, Tesla produced 365,000 vehicles, which is a massive 54% increase year over year. So as it stands now, Tesla definitely can produce at a level that will support a 50% annual growth. Now, based on the current production pace, from Q3 at least, Tesla is currently operating at a 1.5 million vehicles on a trailing 12-month basis, meaning that if you multiply this quarter by 4, you get about 1.5 million cars on an annual basis. And that's with 2 factories far from full capacity. So imagine what happens when these 2 factories, Austin and Berlin, actually go fully operational. That's definitely more than enough to support a 50% annual growth, at least for a few more years. So I wouldn't call BS on Tesla being able to produce at a 50% annual growth rate. Now, what's the real question here isn't the production pace or the production capacity, is the demand. Can we reasonably assume that Tesla will be able to sell enough cars to support a 50% increase? That's the real question. Because if the answer is no, Tesla shareholders are in the world of pain. Now, first of all, Tesla is no longer the only EV manufacturer in the world. Let's face it, there's no point in lying to ourselves, right? The competition is still far from brilliant, but it's slowly getting better. And we can't just ignore that and hope it just goes away if you're a Tesla fan, right? It will have an impact on Tesla's demand. That's just natural. Beyond that, there's only so much $50,000 cars you can sell around the world. There's 80 million cars being sold annually around the world. The average selling price, $28,000. Tesla's cars are selling at double that, give or take. So you can probably push out 3-4 million cars out of the 80 million being sold globally. But that's pretty much where it ends. If you want to sell 10, 12, 15 million cars, you got to do 2 things if you're Tesla in the next 5 years. Number 1, you got to lower the price of the Model 3 and the Model Y. Can it be done? Possibly yes, because look, battery costs are still coming down, inflation is slowing down, supply chains is easing up, and Tesla has shown real excellence at pushing down costs and increasing margins, at least in the past. So I wouldn't just say there's no way for them to reduce prices. It's possible. But the more important element here, and the second part, is that Tesla absolutely has to develop a competitor in the $30,000 category. There has to be a $30,000 Tesla option, at least something close to that. Even the $35,000 will be suitable. Now, the good news are they got about 2 or 3, maybe even 4 years, because they can probably sell 2 to 4 million cars a year, even with just the Model 3 and the Model Y, X, and S out there. So they got the timeline to get it done, and that's enough time for them to roll out an affordable kind of a 4-door a kind of a Corolla competitor for the global market. Now, Tesla doesn't have a demand problem right now. In fact, right now, it can't make enough cars to meet existing demand, unlike what you hear in mainstream media. So that might change in the future, but as far as car demand, it's still extremely strong and should remain strong at least for a few more years. So therefore, my conclusion here is very, very simple. 50% future annual growth based on what we know right now is still a legitimate claim by Tesla. It doesn't mean that this is guaranteed, but it certainly means that it is possible and even probable.